Study Objective 2 talks about ways in which we can use the financial statement information or analyze the information that is shown to us in the financial statements. And a lot of times we do this through something called ratio analysis. We calculate certain measures and we determine if the resulting answer is a good indicator or a negative indicator. And so we'll look at three different kinds of ratios: profitability, liquidity, and solvency. Profitability ratios, as the name suggests, deal with a company's profit and whether or not it's an acceptable level of profit. Liquidity ratios deal with a company's short-term ability to pay its obligations. Okay, so short-term being the key here. And solvency ratios measure ability of a company to survive over a long period of time, basically meaning this is a long-term indicator of whether a company can meet its debts. Okay, so kind of just going through each of those ratios, using the income statement, since this is a statement that derives or calculates the profit of a company over a period of time, we use a profitability ratio called earnings per share. Earnings per share, earnings like it sounds, the profits per share is a calculation that companies will perform, and that measure is usually best when you're comparing a single company to itself over time. It's not really very useful to compare one company to another because most companies have wildly different numbers of shares outstanding. So this is how the calculation works. If there's no preferred stock dividends, which is typical in this class, then you just divide net income by the average common shares outstanding. Average common shares outstanding is derived by taking the beginning shares that are outstanding or issued to stockholders plus the ending and dividing by 2. And so you can do the calculation like this from the data right here. You can see net income is this number, so that amount divided by the average shares. So you find the average amounts by taking the beginning of the amount, year amount, adding the end of the year amount, and then dividing by 2. And we see that the earnings per share is $2.43 for 09. It was $3.15 for 08. So this in this example, it's going down. That would be a negative indicator that a company's profitability is declining. And knowing anything about Best Buy, it has been declining. So it's a good indicator in this case. Using the statement of stockholders' equity, I'll let you read through this a little bit. Not a lot covered there. Study Objective 4, using a classified balance sheet to address a company's liquidity and solvency. Remember we talked about liquidity ratios as being short-term, a company's ability to meet its short-term debts. So there are two measures that we look at here: working capital, which is simply subtracting current liabilities from current assets. This just gives you a number. It's hard to determine whether this is good or bad because you have a hard time gathering or determining what the magnitude of that number is. You know, just getting a working capital of $20,000 doesn't tell you much unless you know the amounts of these two to determine if you're significantly positive in this calculation. Current ratio is a better way to assess liquidity because it divides current assets by current liabilities, and in so doing, it gives you a magnitude. So you can see in this Best Buy case, 1.08 to 1, it's not much of a clearance, of an excess, current assets over current liabilities. But in 09, you can see for this company, 1.68 to 1, that is a pretty significant amount that current assets exceeds current liabilities. So you get a better idea of overall liquidity here. And then solvency, again, this is the long-term debt-paying ability of a company. And here, this is flipped, so it's total liabilities divided by total assets. So notice no current here. This is total liabilities divided by total assets. And whereas in the current ratio, you were looking for amounts greater than 1, significantly greater than 1, here you're looking for amounts significantly less than 1, so some kind of decimal or percent. The smaller these percents or decimals, then the more solvent the company is.